The March 27th pension shock. Why some seniors are getting an extra $816. Something changed quietly in March, not announced with a press conference, not covered extensively in the national news cycle. But for hundreds of thousands of Canadian seniors, what happens on March 27th could mean the difference between a comfortable month and a difficult one. Some seniors are receiving an additional $816. Others are receiving nothing new at all, and they don't know why. If you are receiving CPP, OAS, or GIS, or if you are approaching retirement and watching these programs closely, what I am about to explain matters directly to your financial situation. My name is Joseph, and today we are going to break down exactly what is happening with Canadian pension payments this March, who is benefiting, who is being left behind, and what every Canadian needs to understand before this payment date arrives. Stay with me, because the details here are important and they are not being explained clearly enough. To understand what is happening on March 27th, we need to step back and look at the broader picture of how Canadian government pension payments have been evolving over the past several years. Canada's retirement income system rests on three foundational pillars. First, there is the Canada Pension Plan CPP, which is a contributory program. You pay into it during your working years, and you receive benefits based on what you contributed and when you begin collecting. Second, there is Old Age Security OAS, which is a universal benefit paid to most Canadians aged 65 and older, regardless of work history. And third, there is the Guaranteed Income Supplement GIS, which is an income-tested benefit layered on top of OAS for low-income seniors. These three programs together form the backbone of retirement income for millions of Canadians. According to Statistics Canada, approximately 7.3 million Canadians currently receive CPP benefits. More than 6.7 million receive OAS, and roughly 2.2 million of the most financially vulnerable seniors rely on GIS to help cover basic living expenses. Now, here's the context that matters. Over the past 2 years, Canada experienced some of the most significant inflationary pressure in 4 decades. The cost of groceries, utilities, housing, and medications all rose sharply. Seniors on fixed incomes were hit particularly hard, many watching their purchasing power erode in real time, while their government benefit amounts lagged behind. In response to this, the federal government has made a series of adjustments to senior benefit programs, some broadly communicated, others far less visible to the average retiree. What is happening on March 27th is part of that ongoing adjustment cycle, and the variation in how much different seniors are receiving, including that $806 figure we mentioned, comes down to a combination of factors that we are going to walk through carefully. Let's be precise about what March 27th actually represents. March 27, 2026, is a scheduled Government of Canada pension and benefit payment date. This is the date on which CPP, OAS, and GIS payments are deposited into the bank accounts of eligible recipients for that payment cycle. Now, for many seniors, this will look like a routine deposit. But for a specific segment of the senior population, this payment reflects recent adjustments that, when calculated cumulatively, or viewed in the context of updated indexation, translate to meaningfully higher amounts than what they were receiving even 12 months ago. Let's break this into its components. Canada Pension Plan, CPP. CPP benefits are adjusted annually based on the Consumer Price Index, the CPI. This is called indexation, and it is designed to ensure that your pension does not lose purchasing power over time as prices rise. For 2026, CPP benefits were adjusted upward. The maximum monthly CPP retirement pension at age 65 is now approximately $1,364.60. For those who began collecting at 70, with the 42% enhancement that delayed collection provides, that figure rises substantially higher. But here is where many Canadians miss the full picture. CPP is not a flat amount that everyone receives equally. It is calculated based on your lifetime earnings history, your contribution record, and your start date. The average CPP retirement benefit is considerably lower than the maximum, sitting closer to $700 to $800 per month for many recipients. This means the gap between what you could receive and what you are receiving can be significant, and understanding why that gap exists is critical. Old Age Security, OAS. OAS is indexed quarterly to the CPI, meaning it is adjusted in January, April, July, and October of each year. The maximum monthly OAS pension for seniors between the ages of 65 and 74 is currently approximately $713.34. For seniors aged 75 and over, OAS is enhanced by 10%, bringing that figure to approximately $784.67 per month. This 10% enhancement for seniors 75 and older was introduced in 2022 and remains in place. For eligible seniors who have not yet fully accounted for this in their retirement planning, the difference is real and recurring, hundreds of dollars per year. Guaranteed Income Supplement, GIS. This is where the most significant financial impact lands for the most vulnerable seniors. GIS is specifically designed for low-income OAS recipients. The maximum monthly GIS benefit for a single senior is currently approximately $1,057. When combined with the maximum OAS payment, a low-income single senior can receive over $1,170 per month from the federal government alone before any provincial supplements are added. Now, the $816 figure in today's headline. Where does that come from? When you account for cumulative indexation adjustments to CPP over the trailing 12 months, combined with the quarterly OAS increase and, critically, GIS recalculation for seniors whose income situation has changed, the year-over-year increase for eligible seniors can reach and in some cases exceed $806 annually, or $68 per month in additional income. For seniors who experienced a reduction in other income sources, investment returns that declined, reduced part-time employment, or a change in household status such as the loss of a spouse, their GIS entitlement may have been recalculated upward. And depending on the circumstances, that recalculation can represent a meaningful financial adjustment. Additionally, some seniors who deferred their CPP collection and are now beginning to receive payments in 2026 at enhanced rates are experiencing first-time deposits that are substantially higher than they initially projected, particularly those who took advantage of the post-enhancement CPP framework. Let's be direct about who this specifically affects and who it does not. Seniors aged 75 and older are the group most likely to see the largest OAS-related increases due to the 10% enhancement that applies to that age group. If you turned 75 in 2024 or earlier and have not verified that your OAS payments reflect this enhancement, that is a conversation to have with Service Canada immediately. Low-income seniors receiving GIS are the group most sensitive to income-based recalculations. If your income dropped in the previous tax year for any reason, your GIS entitlement for the current benefit year may be higher than what you are currently receiving. GIS is recalculated each July based on your previous year's tax return. However, if you experienced a significant income reduction, you can request an early reassessment using what the CRA refers to as a current year income estimate. Seniors who recently began collecting CPP, particularly those who delayed past age 65, are seeing higher initial payments than those who began collecting in prior years, due to both the deferral enhancement and the cumulative indexation applied since contributions were made. Near retirees in the 60 to 64 age range are not receiving these payments yet, but they are directly affected by the decisions they make now. When you begin collecting CPP, whether at 60, 65, or 70, has a permanent impact on your lifetime benefit. Every year of delay between 65 and 70 increases your CPP by 8.4%. That is not a small number. Fixed income households and those relying on OAS as a primary income source. need to ensure that their benefits are being properly indexed and that they have filed their taxes on time, because failure to file can result in benefit interruptions that are both stressful and avoidable. Let's put real numbers to this, because abstract percentages do not communicate the lived impact clearly enough. Consider a 77-year-old woman living alone in Ontario. She receives the maximum OAS at the enhanced 75+ rate, approximately $784 per month. Her CPP, based on a partial contribution history, is $620 per month. Her total income from government pensions is approximately $1,404 per month. She qualifies for a partial GIS benefit of approximately $400 per month based on her income level. Her total monthly government income is therefore approximately $1,804. Now compare that to what she would have received 2 years ago. At that time, before the OAS indexation adjustments of 2023 and 2024, and before her GIS was recalculated following a drop in her investment income, she was receiving closer to $1,600 per month. That difference, approximately $200 per month or $2,400 per year, is not trivial. It is the grocery bill. It is the heating cost. It is the copay at the pharmacy. For seniors in lower income brackets, where GIS eligibility is higher, these adjustments are even more substantial. A single senior with minimal outside income who qualifies for the near maximum GIS could be receiving close to $1,800 per month in combined OAS, and GIS alone a figure that has risen by more than $800 annually over the past 2 years due to indexation. The $816 figure that anchors today's discussion reflects a real, achievable annual increase for seniors whose benefit combination has been properly adjusted for inflation and income changes. It is not a windfall. It is not a special payment program. It is the compounding result of indexation working as designed, but only for those whose situations are being accurately reflected in the system. It is worth stepping back and asking, why are these adjustments structured this way? And what direction is government policy heading? Canada's population is aging. By 2030, it is projected that nearly 1 in 4 Canadians will be over the age of 65. The fiscal implications of this demographic shift are significant. OAS and GIS are funded directly from general government revenues, unlike CPP, which is funded by contributions. As the senior population grows, so does the cost of these programs. The federal government's approach has been to maintain indexation commitments, ensuring benefits keep pace with inflation, while also being cautious about introducing major new benefit expansions that would accelerate long-term fiscal pressure. The 10% OAS enhancement for those 75 and older was a targeted measure designed to address the reality that the oldest seniors face the highest care costs and the most depleted savings. On the CPP side, the enhancement program that began phasing in during 2019 is still working its way through the system. Workers who contributed at the enhanced rates will eventually receive higher benefits, but this will take decades to fully materialize for most Canadians. The expansion of CPP is genuinely one of the most significant improvements to Canada's retirement income system in a generation, but it benefits younger workers most directly. Today's seniors largely do not see its full effect. What this means, practically, is that the government is attempting to balance two realities simultaneously, protecting the retirement security of current seniors while also managing the long-term sustainability of programs that millions more Canadians will depend on in the decades ahead. Pension analysts and retirement income researchers have offered measured commentary on the current benefit landscape. Advocacy organizations representing Canadian seniors, including groups such as CARP, which formerly stood for the Canadian Association of Retired Persons, have continued to push for more robust GIS increases, arguing that the current maximum benefit levels still leave many low-income seniors below the poverty line, particularly in high-cost urban centers like Toronto and Vancouver. Financial planners specializing in retirement income have noted that many seniors are leaving money on the table simply because they are not aware of their full entitlements. The GIS in particular is underutilized, meaning some seniors who qualify do not receive it either because they failed to apply, failed to file taxes, or were not informed of eligibility changes following a shift in their income situation. Economists studying retirement security have pointed to the CPP deferral decision as one of the most consequential and most misunderstood choices a Canadian can make. Research consistently shows that Canadians who defer CPP collection to age 70 receive substantially more lifetime income if they live to average life expectancy. Yet the majority of Canadians still begin collecting at 65 or earlier, often leaving tens of thousands of dollars in lifetime benefits uncollected. The public response to recent benefit adjustments has been mixed. Many seniors express relief at seeing adjustments that help offset inflation. Others express frustration that the increases do not feel sufficient given the real cost of living increases they have experienced. And a meaningful number of Canadians approaching retirement express genuine anxiety, concerned that the programs they paid into throughout their careers will not be adequate to support a dignified retirement. This is the section that matters most in terms of action. Let's be practical. First, verify your current benefit amounts. Log into your MyService Canada account online and confirm that your CPP, OAS, and GIS payments are accurate and reflect current indexation rates. If something does not align with what you expect, contact Service Canada directly. Errors do happen, and they are not always self-correcting. Second, file your taxes on time. GIS entitlement is recalculated annually based on your previous year's tax return. If you do not file, your GIS can be interrupted. This is one of the most preventable causes of benefit disruption for low-income seniors. Even if you have no income to report, file the return. Third, if your income drops significantly, request a current year income estimate. You do not have to wait until July for GIS to be recalculated. If your circumstances changed, a pension ended, employment income stopped, investments declined, you can apply for an early benefit recalculation. This can result in higher GIS payments months sooner than waiting for the automatic annual update. Fourth, if you are not yet collecting CPP, model out your deferral options carefully. The decision of when to begin CPP is one that deserves professional analysis. A financial advisor with specific expertise in retirement income or a certified financial planner can run projections based on your specific contribution history and health outlook. Fifth, check provincial supplement eligibility. Most provinces offer additional income assistance to low-income seniors that layers on top of federal OAS and GIS. In Ontario, this is the Guaranteed Annual Income System Gains. In British Columbia, there is the BC Seniors Supplement. These programs are income-tested, and many eligible seniors are simply not aware they exist. Sixth, avoid voluntary income in the year preceding GIS eligibility. Unplanned RRSP withdrawals, asset sales, or other taxable income in the year before you apply for or renew GIS can reduce your entitlement. If you are approaching 65 or managing retirement income, the sequencing of withdrawals and income sources matters considerably. Looking ahead, several developments warrant close monitoring. The CPP enhancement program will continue to mature over the coming decade. Workers who have been contributing at enhanced rates since 2019 will begin to see the full effect of those contributions reflected in their retirement benefits. This will gradually raise the average CPP benefit for future retirees, but it does not help those already retired who contributed under the old framework. OAS indexation will continue on its quarterly cycle. If inflation remains elevated, these adjustments will continue to add incremental income for seniors. If inflation moderates significantly, the indexation increases will also moderate. Seniors should plan conservatively and not assume that recent rates of increase will continue indefinitely. GIS thresholds and maximum benefit levels are subject to federal budget decisions. Advocacy groups continue to push for meaningful increases that would lift the maximum GIS to levels that genuinely address senior poverty. Whether future budgets will include such increases remains to be seen, and it is a policy area worth following closely. There is also ongoing discussion among policy analysts about the long-term sustainability of OAS as Canada's senior population continues to grow. While no credible proposals to eliminate or dramatically restructure OAS are currently on the table, some economists have argued for further means testing or adjustments to the age of eligibility. These are conversations that will likely intensify as demographic pressures increase over the coming decade. For working Canadians who are 10 to 20 years from retirement, the message from all of this is clear. The public pension system will continue to exist and will continue to provide meaningful support, but it will not be sufficient on its own for most people. RRSP contributions, workplace pensions, TFSA savings, and CPP deferral strategy all matter. The combination of these decisions, made thoughtfully over time, is what the difference between a constrained retirement and a secure one often comes down to. March 27th is one date on a calendar of many. But for the seniors receiving adjusted pension payments on that date, for those who will see an extra $806 over the course of a year, it represents something more than a bank deposit. It represents a system that, imperfect as it is attempting to respond to the real financial pressures facing Canadians in retirement. What concerns me, and what should concern every Canadian watching this, is how many people are not receiving what they are entitled to receive. Not because the system denied them, but because they didn't know to ask, because they didn't file on time, because no one explained the rules clearly enough. That is why these conversations matter. You have worked for decades to earn these benefits. Understanding how they work, how they are calculated, and how to ensure you are receiving your full entitlement is not optional. It is essential. If this video gave you clarity or raised questions you want to explore further, leave them in the comments below. I read them, and I use them to shape future coverage of the issues that matter most to you. If you are not yet subscribed to this channel, I would encourage you to do so. We cover Canadian pension policy, CRA rule changes, OAS and CPP updates, and retirement income strategy clearly, regularly, and without the noise. Share this video with a family member or friend who is navigating retirement income decisions. The information here could meaningfully affect their financial situation. This is Joseph. Thank you for watching. Stay informed and stay ahead of what is coming.